Since being launched in May of 2020, the JPMorgan Equity Premium Income ETF, ticker JEPI, has become one of the most popular dividend ETFs and one of the most popular covered call ETFs for good reason. Its ability to provide a higher than average yield as well as deliver pretty good share price growth has earned it a cult-like following over the years for being an investment that's great for income. And that's regardless whether or not you're retired or you just like a cash-paying investment. And now, as we're closing in on its 5-year birthday, JEPI has amassed nearly $40 billion in assets under management. Likewise, SCHD is another dividend ETF that's also developed a cult-like following. Out of every other dividend growth fund that exists, this one likely has the best long-term share price and dividend growth when compared to other dividend growth ETFs. SCHD is also currently offering the highest dividend yield out of every other growth-focused dividend ETF. So in this video, we're going to compare both dividend ETFs to each other and determine which fund would be the best option for investors who have the goal of reaching an early retirement. We'll look at all of the most important metrics and examine which choice would likely be the best pick for a wide range of different dividend investors. First off, the major difference between JEPI and SCHD is that JEPI uses a covered call strategy. According to their fund's page, it says it uses a time-tested, bottom-up fundamental research process with stock selection based upon their proprietary risk-adjusted stock rankings. Disciplined Options Overlay implements written out-of-the-money S&P 500 index call options that seek to generate distributable monthly income. This is what helps give this ETF an insanely high yield, which as of the making of this video is currently at over 11%. Another key aspect that makes it stand out from SCHD and really most other ETFs is that it holds something called equity-linked notes. ELNs are like a mixture between a fixed income investment and regular equity investments. They don't pay a fixed interest rate, but rather their performance is tied to the performance of an underlying security. According to JEPI's prospectus, up to 20% of what's inside this ETF can be allocated to these, and they also help make JEPI a less volatile investment than an S&P 500 index fund. I have talked about the fact though that JPMorgan doesn't really give us a whole lot of information about these ELNs. We don't know what exactly these investments they're tied to, and I think it's just a really important downside. This means that up to 20% of what's inside of JEPI is somewhat of a mystery to us. Another huge positive though is that this JPMorgan ETF pays monthly distributions, which SCHD doesn't. That makes paying for lifestyle expenses much easier compared to being paid quarterly. Also, JEPI is quite a bit more diversified in the number of holdings that it has. So all things considered so far, this ETF sounds like a great choice for people who want to live off dividends. How on earth could SCHD beat JEPI if your goal is high dividend income now? Well, there are a couple of areas where SCHD really does dominate JEPI. The first is that in the 5 years after JEPI was launched, we can see that there really hasn't been any dividend growth. Now, to be fair, this largely has to do with when JEPI was first launched. The fund was launched right after the COVID plunge of 2020, and between then and 2022, the market climbed pretty significantly. And then it fell off again until 2023, and besides the usual blips, it kept climbing until 2025. JEPI's dividends often correlate to the performance of the S&P 500. When it rises, then the dividends it pays will rise. When it falls, JEPI's dividends will decrease. This can be a big problem if you're retired. You don't want to see your income go down, and sometimes a lot, in a bear market. But for the entirety of this fund's existence, the market's been pretty volatile. And in my opinion, although a 5-year dividend track record is pretty decent, I would like to see a lot more than that. If we look at SCHD's dividends over the past 5 years, you'll see there's quarters that are better than others in terms of dividend amounts. But it's very obvious that there's been some pretty consistent dividend growth as time has gone on. If we look at the entirety of SCHD's history, then it becomes clear that over time, dividend growth is very consistent and faster than every other dividend growth ETF that exists. And that's going to be regardless of how stock market prices are moving. If the market is red for a few months, then your income won't be impacted. SCHD did not experience a dividend cut during the COVID plunge. A second major area where SCHD kills JEPI is with taxes. Now, this obviously won't matter if you're doing all of your investing inside of a Roth IRA, where all your dividends are going to be tax-free. But the issue with that is you can't live off dividends from a Roth IRA before you're 59.5 years old without paying penalty taxes. And that's also assuming that age will never go up. If it's your goal to live off dividends, whether fully or partially before 59.5, then you need to invest in a non-retirement account. 100% of all the distributions paid by the Schwab Fund are qualified dividends, meaning that they're tax-free up to a specific amount. SCHD only holds investments that pay tax-efficient dividends to its shareholders. JEPI, on the other hand, will pay dividends from a mixture of different sources. You can see from last year's 1099 that only a small percentage of their dividends came from qualified sources. The majority of their payments were from non-qualified holdings, which can be treated in multiple different ways if you're investing outside of a Roth IRA. So SCHD is a much more tax-efficient investment than JEPI in a non-retirement account. The Schwab ETF has a lower expense ratio as well if you're the kind of person that hates expense ratios. SCHD's expense ratio is only 6 basis points compared to JEPI's 35 basis points. Finally, if we compare both ETFs side by side to each other, we can see that from a total return perspective, the Schwab Fund has done slightly better. Of course, these results are assuming that you're reinvesting all of your dividends, which you're hopefully doing if you don't need the income right now. If you're not reinvesting your dividends, implying that you're living off them, then this is how these ETFs have fared. In that scenario, then SCHD pulls out even further ahead than JEPI. So we can see that although JEPI does offer the best dividend yield by a pretty sizable amount, there's still a couple of downsides to going all in on this investment. Income that's dependent on whatever the stock market we're in is currently doing, and a much more variable payment from each distribution to the next are two things that would impact your retirement. But SCHD's lower yield would mean not being able to retire as soon if you have less money to invest. If you're deciding which holding would be best for living off dividends, it's really going to depend on where you are in life and what your priorities are. If your biggest concerns are avoiding taxes in a non-retirement account or a high expense ratio, then SCHD will be the more appealing investment for you. Over the years, I've known plenty of people who are really passionate about avoiding taxes as much as possible, or people who refuse to invest in any fund that charges more than a Vanguard index fund. In that case, JEPI probably won't be on your radar. But SCHD is also more appealing to another group, which is people who are younger and are serious about committing to dividend investing. If you're in your 20s or 30s, for example, and you're fully committed to regularly putting money into SCHD, then in the future, you're going to be earning a lot of dividend income. And despite its much lower yield, it's not going to take as long as you might think because of the dividend snowball that'll occur from reinvesting and the dividend increases. Of course, reinvesting JEPI's much higher dividends will also build a snowball. This ETF is well suited for people who are at or close to reaching retirement. It's also for people who just love a cash-paying investment. As I always like to say, do whatever motivates you to save and invest more money. If you're 18 years old and you're more motivated to put money into JEPI than you would be SCHD, then focus more on JEPI. You're not going to lose money on this investment over the long term. But if you want my suggestion, then I would suggest holding both positions, regardless of your age or how much you choose to invest. What percentage you'll allocate towards each ETF will have to be your own decision. If you're younger, then I would suggest allocating more towards SCHD, but again, do whatever motivates you most. Once things return to normal in the stock market, where fears of a recession or a recession itself are over, then hopefully we'll get to see better dividend growth from JEPI. Let me know your thoughts and if you prefer JEPI or SCHD. But with all that being said, that'll wrap up today's video. If you'd like to connect and also see what's inside my own personal dividend portfolio, then feel free to check me out over on our Patreon, where you'll receive updates and be able to talk to me and other higher yielding dividend and income investors. But with that being said, thank you all so much for watching today's video, and until next time, take care.